What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, we're going back to the after hours comment section of my financial education question that I posed to people on the after hours platform. And I did get a message from Geo21208, and he asked me, he said, Fridge, I want to know more about the RSI for health of stocks, how it applies to earnings per share and valuation, and implied volatility in relation to options trading. Thank you so much. So that is a lot. So, Gio, I'm going to do my best here to really cover to the best of my ability how this is going to work. Now, again, I'm not a financial expert, by all means. I'm just someone who does a lot of research in their free time and loves talking finance here. So we'll start with the basics first. We'll go over what RSI basically is and implied volatility, and then we'll kind of dive more into how the RSI could potentially impact the earnings, how it could impact the valuation, the stock health, like all those kind of things we're going to be talking about and kind of going from there. So hopefully I'll be able to answer your questions and hope you guys are ready for the video. If you are excited for the video, feel free to like the video, subscribe to the channel, and turn on bell notifications for all future uploads. Now, after doing a little bit of research and looking into this here, it's actually something that I haven't really considered much, but it does make a lot of sense. So we're going to start with the basics here. And the stock I have pulled up is HIMS, which has been in a tear of a price increase and momentum and everything else, because after post-election, they had a Super Bowl commercial that came out as well. That seemed like it went really well. So they have this huge pump in the market, as you will see, back from January 10th all the way up till now, February 18th. Huge red day though today, down, or at the time of recording this was yesterday, down 26% almost, which is absolutely wild. But that had nothing to do with them. It has something to do with one of the, I think it's like Novo something, one of the medical companies was like, oh, we don't have a shortage of like Ozempic and weight loss drugs. And then they're like, oh, we're going to go over to that and don't want to invest in HIMS anymore or whatever. So something like that happened. We got a huge, crazy sell-off day. Honestly, I'm kind of curious to see how HIMS is going to do. Their earnings are, I believe, on Monday. Yep, Monday. Perfect. And what we're going to be looking at is, again, RSI, implied volatility, options, earnings per shares, P ratios, all that kind of stuff to give you that kind of understanding behind it. So let's get right into it. So first of all, RSI stands for the Relative Strength Index. And if you're not really aware about what it is, your RSI, you could put, is an indicator. Now, again, with indicators of any sort, make sure you don't have just one, because a lot of these indicators can be lagging indicators, as in they don't, they're not perfect. You might see a pattern, but the stock already sold off, whatever the case is potentially. So keep in mind that having multiple indicators and multiple things can definitely help you out with having that kind of confluence you need to make these trades and everything else. But RSI basically trades between, the two major numbers are 30 and 70. Again, it's the relative strength index, how much strength there is in the stock, momentum and everything else. If your RSI is above 70, which, as you can see, HIMS was from here, January 30th, up till literally yesterday, or basically yesterday. If it's above 70, which was at what was it out here, 80 something, you look at mid 80s, which is crazy high, that usually could be an indication that the stock is being overbought and there's too much hype around it. It's pumped up way too much. It's almost like I look at it as you're overheating. The stock is overheating and it needs to cool off. So your RSI, if you go above 70, could be an indication that the price of the stock is too high, it's overvalued, and it needs to come back down. Okay. Now, things to remember with RSI, like an example like this where it's overbought, as this case here, is just because it's above 70 does not mean that automatically it has to come back down. It could stay above 70 for some time period, as you'll see here. It broke above 70 at January 30th, and it stayed there for almost a month of above 70. So just something to keep in mind about when you're looking at a stock, and you say, oh my God, Fridge, it broke above 70, it's going to come back. It might not for a little while at least. It definitely usually does come back, as you will see here. HIMS kind of goes up and down, it follows these values, it follows these RSIs, but you just don't know when. You could be up there for a long time. This was the longest it's been, actually. It was above for almost a month, above 70, because there was so much momentum for the Super Bowl, for the election, everything like that. A lot of hype behind it. So if it's over 70, it usually is an indication that it's starting to get overbought. It's probably going to have some sort of pullback at some point. We can't indicate when, but it just kind of depends on what the stock is doing. If there's any new news coming out, those kind of things definitely help. And it's the polar opposite for under 30. If you're under 30, it is considered to be oversold. It's sold off way too much, and the RSI goes below 30. So if I want to take a look, I wonder if it's on here for the... You take a look at this one, like the shorter time frame here. So as you can see, it was really, really oversold at the very, very beginning. That's where you had that huge dip in HIMS at the very, very beginning of the market open. Huge dip, goes below 30. Again, it was all the way down at like 5, which is crazy. And that was pre-market also. Then it kind of comes back a little bit. Then it kind of is trading here. So again, the RSI updates based on what time interval you're looking at here. Again, you look at the daily one. I always have to look at longer time periods because swing trading and not just day trading. Swing trading is really usually my kind of like logic to think about because it gives time for the plays to happen. You know, I can't be there on an instant to like make a change, make a buy, make a sell, whatever it is. I have to do it over like time periods, like a days, weeks, whatever the possibility is. So, you know, bigger time period, looking at the 1 day chart here, again, overbought, as you can see here, and then it had a huge red day. But that's based off of news also. It could have just kept going up. Who knows, right? But so that's what the RSI is, the relative strength index. Now, the relative strength index, again, 70 overbought, 30 oversold. Okay. And it usually tends to come back into like the range. If it's between 30 and 70, then you're basically neutral. Nothing too crazy going on in that aspect in that case. So that kind of like explains how RSI works. Now, implied volatility is really something to do with options, and it's the percent. They're looking at the volatility, looking at how much they're expecting the stock to move. Now, what you'll see is that companies that have a lot of momentum, a lot of growth potentially, have way higher implied volatility, especially with earnings. For example, if you take a look at the options chain for HIMS, here's your implied volatility. It's over 200%. They're expecting a monstrous move with their earnings coming out on Monday. You know, because again, it has a lot of hype. It's a lot of momentum behind it. There's a lot of volume being traded here, right? There was 89 million trades on Friday. Yesterday, that's how I'm recording this. The average volume is almost 17 million over here, right? So there's a lot of hype, there's a lot of trading, a lot of volume behind it, which means there's going to be a lot of movements in these stocks and in these shares and everything else. There's a huge implied volatility. Now, again, this is a huge factor that comes into what you're paying for your contract or what you're selling your contract for, essentially. So, for example, the people that were owning these call options here that expired at the end of this week coming up, the 28th, they've lost 62%, 68%, 54% of their value of these because, again, it had a huge move to the downside. So you're losing a lot of that value in your contract that you bought. Or you're gaining a lot of value if you sold it instead of buying it, essentially, right? If you bought put options, basically hoping that it'll go down, people were making a killing. 400%, 300%, because the implied volatility is so high. You're going to have a bigger expectation of bigger moves in this stock. And when it comes with earnings, the implied volatility usually gets juiced up because, again, earnings tells you the forecast, the projections, how they just did recently, and if the stock still, and if people don't like what the company is doing, boom, stock sells off, loses maybe 10% of the share price in a day. That's why you have these higher implied volatilities. Like Nvidia, for example, they have earnings coming up this week, so they have a juiced up premium, 80%, 90% for some of these contracts here, whereas usually they're like 50 to 60. So they have a little bit more of a jumped up value in these premiums because, again, earnings comes out and shows you what the company's doing, how they're doing, what does it mean for the future, and that's what investors are watching closely. So that's how implied volatility essentially works. The higher the implied volatility, the more movement you're going to get in a stock. So for example, if you wanted to go to the S&P 500 index SPY, you'll take a look and see their implied volatilities are a lot lower. Why? Because your S&P 500 doesn't move 3%, 6%, 12% in a day, down 25 like HIMS. It moves like 0.5%. maybe 1%. Today or yesterday, it was down 1%, which is why you got a huge print here from these results. But again, their implied volatility is a lot lower because a lot of people don't expect a huge move from ETFs like SPY because, again, it just is the overall market. So these growth stocks that you're looking for, if you're looking at higher premiums, you're looking at growth stocks that have higher implied volatility. Let me see if I can find another one here as an example here. Palantir is a good one. Pretty high implied volatility, 70 to 80% here. Again, these were probably a lot higher when they had their earnings out recently. So definitely something to keep in mind about. What else do we have here? Let's see here. I don't know if any of these. Coinbase has been getting absolutely destroyed. Don't remind me. I have CONL's leverage ETF. Don't ask. But again, higher implied volatilities because again, that moves a lot more as a company, down 8% today. Again, and it prints because again, that implied volatility is what the market is expecting to have something happen as a result. So that hopefully kind of covers what implied volatility means. It kind of leads back into my focus of. We go back to HIMS here. And honestly, I'm curious to know if I want to get into HIMS at some point. So hopefully I'm waiting to see what earnings does on Monday. If it doesn't do what people want it to do and it comes back down, I'm kind of cool with maybe starting to open a position on that one. We'll kind of wait and see obviously how it goes by ear. But then he asked the question again, that follow-up question was focusing on, the RSI for the health of stocks, how it applies to earnings per share and valuation. And at first you say, well, it's an indicator. It has nothing to do with earnings per share, nothing to do with valuation, nothing to do with anything of that nature. And you're right. It has no direct correlation here. But there are things to still consider, okay? So even though the RSI does not directly affect the earnings per share, it can still have some sort of impact on the earnings per share performance and everything else. For example, if the RSI is high, which in this case it was very, very high before it had a little bit of a pullback here, that means that you're looking at probably having investors that are thinking, wow, this is a really bullish stock here. We're looking for high earnings per shares. We're looking for those beats in the earnings per share and paying in all that money. And the problem is, let's say that HIMS reports Monday morning and earnings per share comes in lower than expected from their earnings report. You're going to see a huge pullback in the RSI, in the stock, and everything else. Because this is telling me, obviously before this day, this is telling me that people have some hype around it and they're expecting a very good earnings report from HIMS. And if HIMS doesn't have a good earnings report, you might see this RSI get pulled back farther and see the stock come back down more because, again, it's not meeting the expectations of the investors. Obviously, on the opposite side, let's say that this was going bearish into the earnings report and it was oversold. Let's say it was under 30, for example. And then it comes in with the earnings per share and it comes in with a beat. It comes in with a better than expected earnings per share, a better than expected earnings report overall. You might see the RSI get pulled back out of the 30, back into the 40s and the 50s, and the stock get a nice rebound to it. So there's no direct, like the RSI is 70, so that means that this is going to happen. There's no direct correlation there, but it's things to consider where it's like if earnings per share comes in lower than expected and the RSI is hot, it's going to get pulled back down is what a safe assumption would be because it missed out on the earnings and vice versa if it's oversold. The other thing to consider with RSI, as you're taking a look at something like this here, is the valuation, like a PE ratio, right? So a PE ratio is one of those big ones that people look at, which is your price to earnings ratio here. And usually a discounted value for a PE ratio is like under 20. S&P 500, SPY trades at about 20 to 22-ish. Usually 20 and 25 is a good range for it. NVIDIA is at like 50. I think Apple's like 30 something. AMD is like 110 or whatever. And the higher the PE ratio is, the more of an expectation we are looking for. And we're looking for them to have a lot of growth in a company. Now, you can't see on my screen because I think I cropped it out weirdly. I wonder if I can move this here really quick. Oh, there we go. Fixed it. So as you can see here, their price to earnings ratio for HIMS is looking at 113.92. And they're forecasting 90, which means that this is coming in way too hot, right? And the thing about this is when you're looking at PE ratios, if your RSI is high and the stock is overvalued, again, a high PE ratio, which this is higher than NVIDIA, this is higher than Apple, this is higher than AMD, this is higher than Google, higher than Meta, higher than Tesla. Maybe not. Let me see, actually. I don't want to say that into existence if Tesla actually is higher than 112. Nope, never mind. Not higher than Tesla. Tesla is higher than HIMS. So I want to make sure I fact check myself on that one before I say that kind of accusation. I know it's higher than Google, Amazon, Facebook. I know that for a fact it's higher. I didn't know about Tesla. Tesla's 165. That's also crazy high too. But so if your RSI is pumping up high and you're looking at a high earnings per share, you're looking at a high PE ratio, you're looking for a lot of growth. And if HIMS comes in and has less growth, your PE ratio is way overpriced. It's going to reflect in the numbers and you're going to see that RSI kind of pull back down as well. So, and vice versa, as we know, it goes in the opposite direction as well. So thank you so much for watching. I hope that kind of gives you a little bit of an insight as to what RSI is, what implied volatility focuses on, how you can use it to see how earnings per share goes with earnings, as well as PE ratios. Again, is it the end all be all? Absolutely not. Okay, but these are great questions. And Gio, it's a great question that you asked, and I appreciate taking the time to ask that question. And hopefully this gives you a bit more of an insight as to how this works. Feel free to always drop your comments down in the comments section you made this far in the video. Anything you want me to go over, explain, do research on, pull up data about, pull up charts about, look at the data, the financials, anything of that nature, hit me up either after hours, YouTube, Instagram, on here, whatever it is you need. So again, thank you so much for watching today's video. I hope you guys are making money in the market in some way, shape, or form. And I will see you guys in the next video.